We are covering a global market sell-off this morning.
Wall Street is about to close any minute now. The Dow collapsing, its worst single-day loss ever.
You think that we're going further south on this market, don't you?
I do, Stuart. Last night at around 12:05, if you follow astrology, Mercury is in retrograde.
Have you ever noticed that every time the stock market drops by just a tiny fraction of a percentage point, that you can turn on any financial news network or scroll through any social media platform, and you'll find no shortage of talking heads just yipping and yapping about, oh, this is the big one. This is going to be the stock market crash of all stock market crashes, and you should be worried. They're going to try to tell you that the economy has never been this bad, that the job market has never been this bad, that inflation has never been this bad, that geopolitical tensions have never been this bad. They're going to try to tell you that the world has never been this bad because they want you to believe the greatest investing lie that has ever been told. And that lie is this time it's different. That the stock market is going to crash and we're never going to recover. In spite of a 96-year documented history since the inception of the stock market itself that shows through every single crisis, war, financial mistake, and problem that we have ever created, there has been one true constant in this world, and that is the stock market has always found a way to go higher. Yet some people still insist on trying to make you believe that a certain political party, a certain movement, a pandemic, or a financial crisis is going to upset the balance of the world financial system and send us all into some kind of apocalyptic world. But year after year and crisis after crisis, as the market continues to tick higher, the so-called economists stand there in disbelief, looking dumber than they have ever before. So today I'm going to tell you why they keep telling you this lie, and why investors from around the world continue to fall for the same old trick time and time again, and how this very lie is specifically engineered to separate the naive from their money. More importantly, I'm going to show you how you can take this lie and turn it into profits for yourself. So how about we start with this? What exactly is a stock market crash anyway? Well, according to economists, a stock market crash is anytime there is a rapid reduction in stock market prices. Now, some economists believe that number should be 10%. Others believe it should be 20%, while some believe it should be as much as 30%. But here's the thing. There isn't a specific metric to measure what a true market crash is. That's entirely up to the interpretation of the investor or trader. So anyone could look at any rapid reduction in stock market prices as a market crash. It's kind of like the word bubble, a word we hear often when we see rising asset classes. Well, according to economists, that's exactly what a bubble is, a rapid increase in market prices. Again, there isn't a specific metric to measure what a bubble is. That's entirely up to the investor and trader. Which means if this is true, that anything you see could be interpreted in any different way, which means does it even exist in the first place? So since there might be a doubt to what a true market crash is, let's take a look at some of the negative and positive years on the stock market. Then we'll take a look back at some of the most recognizable market crashes in history and see the response to each and every one of them. Now, since the 96-year inception of the stock market, there have been 26 negative years. So right off the bat, the stock market, also known as the S&P 500, has been positive 73% of the time. Just that statistic alone is enough to buy the dip in most situations. In addition to that, there has only been 3 years where the S&P 500 has declined by more than 30% in a 12-month span. That would be 1931 at 43.8%, 1937 at 35.3%, and 2008 at 37%. And there's been 3 times the S&P 500 has declined by 20% or more, 1930, 1974, and 2002. So there's only been 6 times out of almost an entire century that the stock market has suffered a deep decline. So let's take a look at the 3 worst market years in 1931, 1937, and 2008. 1931 and 1937 was in the midst of the Great Depression, which is the worst economic downturn in United States history. A lot of people associate the start of the Great Depression with the infamous Black Monday stock market crash on October 28th of 1929, when the stock market dropped 13% in a single day. It would then follow it up on Black Tuesday, when the market would drop another 12%. This slide would continue in the markets for another 3 years into the summer of 1932, when the Dow Jones would close at $41.22, its lowest value of the 20th century. And the stock market would not return to its pre-crash heights until November of 1954. To this day, this remains the longest and deepest bear market in history. And over the last 90 years since then, a million different economists have predicted that one day the stock market will experience another 90% decline with a 20-year recovery period. But it probably won't happen, and here's why. If we take a look back to that era in market history, 9 of the first 14 years were negative. This era makes up for 34% of the stock market's total historical declines. Now, of course, the Great Depression was a leading cause of that decline, but also, in those days, there wasn't very much stock market regulation. It was truly the wild, wild west filled with unpredictability. But you can see as the years have passed and more legislation, regulation, and fail-safes to keep us from ever returning to that position again, the stock market has become less and less risky. These rules were so effective that it wouldn't be until the financial crisis of 2008, 71 years later, that the stock market would ever be down by 30% for the year. This regulation has also led to the average bear market lasting for a little over a year, while the average bull market lasts anywhere from 8 to 12 years. And that brings us to 2008, the site of the infamous financial crisis, where at one time it looked like the entire banking system was going to fail. But something happened in 2008 that would change the course of market history forever, and that thing was quantitative easing, also known as QE. Quantitative easing is a monetary policy that's used by central banks to increase the money supply in an economy and stimulate economic growth. In layman's terms, the Federal Reserve just prints up a bunch of money and bails out the stock market. So in November of 2008, the Federal Reserve started buying $600 billion in mortgage-backed securities from commercial banks. This would flood the banks with excess liquidity, and they saved the market, and since that moment, we've pretty much been on a straight-up trajectory. But here's what's important about QE. It was supposed to be a one-time desperation play by the Federal Reserve to save the world. But what it ended up becoming was a tool to abuse the system and control markets. Because now, anytime that the market is ever faced with any adversity of any kind, the Federal Reserve immediately prints up a bunch of money and bails the market out, just like they did when COVID dropped the market by 30%. And see, the stock market knows this. Everyone on the street, all of the big banks, all of the big hedge funds, all of the high-frequency traders know that if shit ever gets sticky, the Federal Reserve has your back. And this has led to fewer and fewer pullbacks and less volatility, because all of the fear is gone. Call it rigged if you want, but that's the reality of the situation. Because the truth is there's just too much money on the line for the market to fail. The whole entire world depends on the U.S. stock market. Every country in the world has money invested into the S&P 500. We may disagree politically or morally between countries, but we all speak the universal language of money. Kings, queens, oligarchs, governments, allies, enemies, everybody's got a hand in the pie. So I guess if this is true, and according to history it is, then the question becomes, why do they keep telling us this lie over and over again? And is this lie specifically engineered to separate you from your money? And the answer to that question is yes, it is. And I'll explain it like this. Psychologists believe that we have 6 major emotions: sadness, happiness, fear, anger, surprise, and disgust. And this lie preys on the strongest emotion we as humans have, and that is fear. Because fear makes you do things you normally wouldn't want to do and not ask questions about it. Like, you don't want to die from this sickness? You better go get yourself a shot. You want to live a long time and a healthy life? Better not eat that food. Don't go to this place, it's scary. Someone is always trying to fearmonger us into doing something or panicking over a certain situation, because fear sells. Every time there's a market correction, fear gets ratings. Every time there's a sell-off, fear separates people's money from themselves so larger banks and institutions and hedge funds can accumulate these shares on the cheap. This is exactly why Warren Buffett has tried for several decades to warn everyone that when there is blood on the streets, you buy. But sadly, that formula for the retail trader and investor is completely backwards, because they're always buying in the euphoric moments when everybody is greedy, and they're selling in the panic, and the cycle just repeats itself. But for the social media keyboard warrior's so-called professional investor or trader, they fearmonger for a much different reason. They're fearmongering you out of the other emotions like anger, surprise, and disgust. Because they're angry they have missed yet again another generational buying opportunity, and they have to imaginarily account the upteen thousands of dollars they've cost themselves by missing this rally. They're surprised that every single day, in spite of bad news, that the market just keeps clocking all-time high after all-time high, seemingly not wanting to pull back, frustrating them even more. And they simply are disgusted with themselves because year after year, they continue to miss these quality buying opportunities, and they no longer can look themselves in the mirror. So they must fearmonger you so they can draw you down to their level. So does this mean there's never going to be a stock market crash ever again? Is it going to be like Janet Yellen said many years ago, there'll never be another financial crisis in our lifetime? Will we never see another rapid reduction in stock market prices? Sure we will. There will be crashes, but as you should know by now, they're just normal functions of a normal market. We've dealt with several crashes, and we've dealt with several problems in our history, and this time, it's not different. So the next time there's a rapid reduction in stock market prices, I want you to look at it this way, especially you new traders and investors. If you don't get a crash in asset classes, you're always overpaying. Your entry point is so high that it's going to be hard for you to make money. These are brief opportunities in history where the stock market and investing gods have handed you on a silver platter the opportunity that you have been begging for, that people have been bitching about as they watch markets go up. Give me a pullback. Give me a pullback. Give me a pullback. Well, here's your pullback. And don't be an idiot. Buy that dip.